Morning, everybody. How the heck are you guys doing? Good to see you this morning. Great conversations in the room already. I love it when that happens, guys. Hey, what's going on, Rick? Ron, always good to have you. I love that Wayne showed up and said, "Man, I hit my goals. I'm gonna go do something fun." Good stuff. Good morning, Cav. Good afternoon, Miss Jen. Um, Jen, you're probably bummed. You're like, "Man, now there's more lines that I can't trade into." Um, I like it though; it increases accuracy. Guys, good morning and welcome. It is, I'm excited to be here today. We had some great lessons yesterday, some great conversations. And I think we're going to have more today. Good morning, Steve Diego. Great to have you here this morning. I like it because I know you're up as early as I am. Darn West Coast. Guys, every morning I'm checking news. Don't tell Runcie we spoke about him. I would never mention it, ever, ever. And I'm looking for reactions. I'm looking for something that could create a reaction, something that could upset the market, that could push it or make it spike or reverse or just really too fast to be tradable. So every morning I come to forexfactory.com and I just look for those red boxes, those high impact boxes, guys. Core CPI, CPI, CPI. There's a lot of CPI, and it all happened at 8:30 a.m. Eastern. It happened at 6:30 a.m. in Guatemala, apparently. That was kind of funny because that happened to me too. Um, so I'm looking at this and I'm saying to myself, okay, somebody with a lot of money might react. Somebody could set things in motion that doesn't fit my patterns, and I just choose not to trade. I choose not to trade into high impact news. And I'm going to be honest with you, it doesn't matter to me what the news is, guys. I don't have a wow, good question, Syed. Um, you can I give you the real answer? And you're not gonna like my answer. But I'm gonna be very, very honest with you. I don't know. I don't know, Garrett. Syed, I don't understand the technical programming side that goes into. I don't look at the numbers, and I know that probably sounds weird that I teach the class. I can get the answers for you, and I will get the answers for you. Um, but I know how to read them. And my job is to teach you how to read them. And one of the things that I was told when I started, because I was asking those same questions, I thought I had to know everything in order to be successful with the software. And my brother told me, he goes, Mark, you don't have to be able to build a watch to tell time, and you don't have to be able to understand internal combustion to drive a car. But Syed, I will get you the answers. Um, and I don't think the numbers that go into them are important personally, but I do believe understanding how to use them effectively and how they relate to the patterns we're looking for in the rules that we teach. That's where they pay dividends. And it's weird that I wouldn't know that, but there's numbers. I know that the EMA is what's being used as a midband, and I can't remember what the number is that makes it. And I'm not sure what the numbers are. Um, oh, well, no problem. So let's do that. I'll tell you how they're important to trading. And maybe when we have time, you can teach me how they're calculated. And we'll both walk away a little smarter. I like that. Good morning, Bejoy. Good morning, Wayne. So we'll go over it. We'll talk about how they're used and what they look like and all that. You're a math geek? See, I'm English lit major. So you and I are mortal enemies in a collegiate setting, but we need each other. One of my best friends I used to race motorcycles with was a brilliant mechanical engineer. Um, Scored perfect on his SATs on the math side, but he couldn't formulate a sentence to save his life, and we really worked well together. It was a lot of fun. Good morning, Izzy. Good to see you, man. Um, if it doesn't have a spark plug, I struggle with it sometimes. So let's go through this. And I'm going to go through indicators a little slower today, Side. I want to make sure that you understand exactly what we're looking at and exactly how it will relate to you and what we teach. But news is always first. And guys, at 10:30 a.m. we have crude oil inventories. So if you are a crude oil trader, this is, even though it is low impact, this is something that can affect the market. This is something that can create spikes in crude oil. And very often, some days, guys, you'll see them almost jockeying for position as we get closer to that time frame. Um, and I understand what they're doing here. They're announcing the reserves release, the numbers. And there are people that say, hey, if it's positive, I'm going to go long. If it's negative, I'm going to go short. And these people have a lot of money, and you'll see them try to get into position. So just be aware that on crude oil inventories days, maybe starting around 10 a.m., you might see a little lack of follow through. And then once you get to 10:30 a.m., depending on the news, there can be a big spike. And I know a lot of you trade crude oil, so just wanted to put that out there. And then everything comes from this page. I'm going to give you a link real quick to the indicators. John Novak actually does a little more mathematical review on them here. If you're interested, the video is great. And he talks about the things that make my brain go deer in the headlights. But he does talk about the numbers and the regressions and stuff like that. What I'm going to do is I'm going to talk about it in a little more simple, if you will. So let me find. Let's do the first one. Well, let's just do this. We'll go to a live market. So you're going to see on your charts, and this is a large chart, but it's okay. I'm going to pull everything off, and the first indicator that we're going to talk about is going to be trigger lines. And these are those moving averages. So when I take everything off but the trigger lines, that was a self-imposed fib, I think. When I take everything off, you're going to see the trigger lines. So the trigger lines are moving averages, and there is a fast moving average, and that is going to be the smaller trigger lines. So you're going to see two solid lines, and these are your smaller moving average. Average, and they are fast. And we just call them small triggers. Let me type that in. It's a faster moving average, not a smaller moving average. Sorry. See, this is why I'm not the tech guy. And then we have on the other side the dashed lines. And the dashed lines are the large triggers. And these are a slower moving average. I don't know the numbers that go in, but I believe you can look at the indicator settings and you can see exactly what the settings are to create them. But these small triggers and large triggers, these moving averages, we use them for three different things. The first thing that we use them for is rule number one, and we'll define the momentum in the market with the trigger lines. When we're using them for rule number two, we'll define areas that may stop the market. And when we use them for rule number three, we'll use the large triggers to define our entry point. So triggers are going to show up in everything that we do. You're going to see triggers on both charts. You're going to see triggers being used for rules 1, 2, and 3. The only thing that you have to know to be successful with these trigger lines is that the fast are the small triggers and the slow are the large triggers. So there's your first indicators, your trigger lines. You're going to see them on both time frames. The second indicators are going to be those areas. So I'm just going to put my template back in, and I'm going to bring up all the good stuff that shows up on a chart. But the areas are nothing more. I like to call them horizontal lines on a large chart. And they all have different, I guess, mathematical properties. So when you look at your chart, whether it's a big chart or a little chart, you're going to see divergence high lines. And these are magenta lines, and they print off of a pivot. So if the market is pushing up and then it comes down, about 2 bars into it, your software is running calculations behind the scenes. It's using price versus a MACD momentum indicator. And if there's a loss of momentum in the push up, you'll see this magenta line. If there's a loss of momentum at a low, you'll see a cyan line. So this is just a visual indication that there was a loss of momentum in the market. And every time you see divergence, you can say to yourself, hey, there was a loss of momentum. You're going to see Fibonacci resistance and support. Those are going to be the red lines and the blue lines that you see on your chart. The math that goes into these is pretty freaking amazing. When you open your software, your T3 Fibs Pro Trader, it analyzes data for the last 10 days, and it looks at it and it measures every swing. I mean, every up, every down, every pivot. It creates higher time frames. It creates synthetic time frames. It's looking backwards. It's projecting forward. And what it does is it creates all of these Fibonacci readings. Then the algorithm kicks in, and this is where I didn't realize my brother was so darn smart. It weighs them and it sorts them and it goes through them. And when John Novak was creating the software almost 30 years ago, he had a friend in the pits in Chicago, and he would send his friend the numbers. These are where my fibs are. And his friend couldn't say, yeah, that's where the institutions are buying or selling. But when he was within about 50 cents of the numbers that his friend knew the institutions were making moves at, that's when Nexgen launched and became a company available for you guys. So from all of these calculations, you get Fibonacci resistance. These are areas on a large chart that can stop the market. This is very good at helping you understand where highs and lows, tops and bottoms may be. And Fibonacci support, same thing. And you see them as a single line, which makes it easier. And then you'll use those trigger lines to decide whether or not they're more likely to stop the market. You're going to see yellow 1-to-1s on your charts, guys. These yellow 1-to-1s are a 100% Fibonacci alternate. They print real time throughout the day. The software is constantly running calculations, and if the calculation is true, these will print. They can behave as resistance if the market's in an uptrend. They may behave as support if the market's in a downtrend. And then you're going to see the midband. That's that EMA, that moving average. And when price is below the midband, you're going to notice that it turns magenta. And a magenta midband can be used as resistance if the rules are true. And when price is trading above, you'll notice that it turns green. And that lets you know that it may behave as support. So you're going to see trigger lines and you're going to see areas. And you're going to see it on your chart. And we're going to use them first to recognize what we call a high probability trend trade. And all it is using these indicators and recognizing a pattern that's created day in and day out. And this pattern happens on really any market. It happens on almost every time frame. I've built charts for feeder cattle, soybeans, and the patterns are true. So what we're going to do is we're going to learn to read the indicators. And this is our first hour of the day. We are going to look at our charts and we're going to use trigger lines and areas, and you'll be able to define a high probability trend trade. And this is a trade that typically wins 70 to 80% of the time when you follow the rules. This is a trade that is going to bore the ever-loving snot out of you because it doesn't happen one trade after another. And that takes me to the most important thing that I think I could ever tell you. The majority of your day is spent waiting. The majority of your day is sitting on your hands, especially as a brand new user when you're only focusing on one trade. 10% of your day is actually trading. But when you recognize the 3 rules that it takes to prove a high probability trend trade true, you're going to understand where the market is likely to continue. This becomes your entries for the high probability trend trade, for medium probability trend trades. You're going to understand where the market is likely to go using those moving averages, the trigger lines, and Fibonacci areas. This is going to be great for profit taking. And you're going to understand where the market is likely to stop. And when you understand that concept, what it does is it keeps you from trading into those key areas that could reverse a trend, that could create an untradeable bounce. So we're going to work on chart reading. And this is my first hour every day. We're going to break down the high probability trend trade. It's only 3 rules deep. That's it. And when each rule is true, it provides an advantage. So rule number 1 is going to use those trigger lines, and you're going to be able to define the momentum in the market. And when those trigger lines are strong, you have the advantage of momentum. You'll find that I put a lot of stock in language, and we talked about that a little bit in the room yesterday as well as today, because it paints a picture, and there's been a lot of studies, and when I see a strong trigger line and I think momentum, guys, it creates confidence. It makes me feel good about it. When rule number 2 is met, you're not trading into areas that could stop the market. You're going to have room to your profit targets, and we're just going to call it a clear path. And when you understand how to identify strong triggers, and you can say to yourself confidently, my path is clear, you have everything that you need to create a very solid, very profitable trading plan. And it's the understanding of the advantages that opens the doors. So focus on these two, really get them down. And your first entry will be the entry for the high probability trend trade. That's rule number 3, defining precisely where the market is most likely to continue. For the brand new user, simplicity typically pays dividends. For the brand new user, rather than looking for the money, rather than looking for the trades, I encourage you first look for momentum, be able to look at your chart and say out loud, I have momentum or I don't. Only one of them leads you to rule number 2, because when momentum is present, you'll check your path. And if you can say, hey, my path is clear, then you'll go define an entry. And rule number 3, guys, this is going to change and grow with you. The better you are at momentum and path, the more entries you're likely to find. These 3 rules happen on only 2 charts. There is a large chart and there is a small chart. Your large chart is very slow. It's a broad stroke of a brush. It shows the overall opinion of the market, and it takes one bar, the most current bar. You'll be able to use the trigger lines to define direction. The trigger lines will also define momentum, and you'll be able to define areas that may be problematic. Rules 1 and 2 come from the large chart. Those first 2 advantages come right from the large chart, right off the most current printing bar. When they're true, you'll turn your attention to a small chart, a faster chart. And this smaller chart, this faster chart, guys, this is your refinement chart. This is where inside of that one bar, you see all the inner workings, and we use this refinement process to really whittle down the best of the best entry, providing the lowest risk and the highest profit potential. I'm going to address that in just 1 second. Said. Is it said or Syed? I had a friend and it was said with the same spelling of your name. And I feel like I'm butchering it, and I apologize if I am. I just wanted to throw that out there. I don't like butchering names. We use these 2 charts, guys. Syed. Okay, thank you for that. Thank you for that. Who are you trading with and who are you trading against, guys? Your large chart, this is where visuals come in and these help. This is a great metaphor. Your large chart is a big chart. It's the big crowd, guys. It's the men and women that are more powerful than you, have more money than you, more influence than you, and I accept that they lead the way. I accept that I don't need to fight them, that my life is easier if I simply trade with them because the large crowd tends to win. Your small chart is like a small crowd, and these are fighters, guys. These are what I like to call ne'er-do-wellers. Because when the large chart collectively wants the market to go up, the small crowd really wants to push it down. And they can. They have the money. They have the influence. But they typically fail 70 to 80% of the time to reverse the trend completely. They create what's called a little retracement. Rule number 3 is designed to have you pinpointing where their failure is most likely to occur. This becomes your entry for the highest probability trend trade when the rules are met over here. And Syed, you're absolutely right. Momentum is separation, and we're going to get to that in just a minute. We're going to find some great examples of it. But, I mean, day 2, and you've already got momentum down. How cool is that? We're going to go over in the next hour. I'm going to talk about each rule individually. We're going to learn the trigger line of Fibonacci rules for when it's okay to trade. I'm saying a lot. I apologize. Guys, it's okay to trade when your rules are met. This is the constraint that I've put on myself. It's okay to trade when my rules are met. It's encouraged for me to trade when my rules are met because my rules are doing nothing more than describing a pattern that's been proven to win more than it loses. So from day 1, I'm going to try to focus more on the method, more on the execution of the method than I am the results. Because if this pattern really can be proven, and you will be able to prove that it wins more than it loses, it creates an edge. And while I may not know what the result's going to be, I know that the result is more likely to be favorable than it is unfavorable. So we're going to learn those rules individually. I'm going to give you the tools you need to study them, and I'm going to answer every question that you have about them. Everybody in the room has the ability to simulate and to practice and to get in, to get out, to work on management, to tell me what you see by posting in the room, by showing me, hey, Mark, I'm playing with the software. I'm brand new. I'm learning some things. I wanted to run this by you. This is what I saw. I saw this in regards to momentum. Those were my strong triggers. And when I was looking for my clear path, I noticed that it only had the potential to break. This is where I got in. This is how I exited. This is where my stop was. And what you're doing is you're saying, hey, Mark, this was my chart read. Is it accurate? Now, what happens is I'm very willing to celebrate, to high five, to gold star, and to tell you, man, your chart read is perfect. But I'm also quick to point out that if you believe and you tell me that you have strong triggers but you don't, we're going to correct it. We're going to go back to the lessons. We're going to reiterate what it means to have strong triggers so that you don't look at weak triggers and have yourself believe that the advantage is present. The same is true with everything, guys. So it's not a matter of being right or wrong. It's a matter of read accuracy. And I do very much look at the language on the charts as well. So when you annotate, this is what I get. So tell me what you saw. Tell me what you felt. And it's like getting a private session with me every time you do. The goal and the hope is that your chart reads become accurate, that you focus on the right rules, because while getting lucky creates that short-term victory, it typically leads to long-term failure because we're trading an edge. I will hand you a plan. When we're done talking about the rules, the plan will have 2 trades on it. The first trade is the high probability trend trade. That's the trade where each indicator on every chart agrees with the rules for the trade. Guys, this is the best of the best. And when we talk about this first hour, I'm literally giving you the best of the best. That's going to open the door through chart reading for what we call a medium probability trade. This is the second trade that you're going to see on that plan. And a medium probability trade means that most of your indicators line up with the trade. However, a small issue exists. You're going to rely on your ability to read your indicators to identify the issue. You'll manage these a little more assertively, a little more aggressively, and you'll use your understanding. This is what I see. This is what's working for me. This is what's against me. And that's going to let you know that it's time to put that management hat on. But you're going to get that. And we just need to figure out what looks we're going to commit to. So first we're going to see the looks individually. What does it look like to have each rule met? And then you're going to see them together to create the full pattern. And that seems to be one of the easiest ways for you guys to learn. So I'm going to give you this spreadsheet. I'm going to do it right now. In this spreadsheet, I'm dropping it in the chat box. Download it, slide it over. It's got 4 tabs. It has 4 tabs. The first tab is each rule broken down individually in green, and then what it means to not have the rule met, the look associated with the lack of the advantage, so that you can commit to having strong triggers, clear path, and a well-defined entry. You'll be able to go back and see over 500 pictures of Nexgen users using the software, and you'll notice that these pictures all revolve around momentum, path, and entry. There's a couple discrepancies. There's some high probability, some medium probability, but these are clients trades, guys. So not only will it reinforce the advantages work, that the methodology is solid, but you're also going to see that there's people all over the globe using the software to find success. If you're working on entries, this breaks down the entries one by one. Typically, that's the one that takes just a little bit longer because there's more moving parts. There's ideas on management, patterns that repeat themselves in the market all day long. I want you to take your pictures, guys, and start filling out this third tab the way I filled out the second. Every time you see a high probability trend trade in your study, take a picture, annotate why you're writing that recipe, and drop it in here. And this becomes your trading plan. This is the pattern that you're committing to. You will learn to manage outside of very basic management, and you're going to start to see things. This patterns that repeat all the time. This is where you're going to start growing your plan, and it's going to come from your ability to recognize advantages. You're just going to start seeing things. When identifying momentum takes a half a second, and it will, you're going to have the time and the mental power to begin to see the other things that are happening in the market that can maybe help with management or entry and stuff like that. And then finally, there's a trade tracking sheet. And this trade tracking sheet is where you're going to chart your growth a little bit, guys. There's a spot for pictures, and there's how to paste them in there, how to annotate for the best feedback. And this one asks you about, do I have momentum? Do I have a clear path? And you will see, there's no doubt in my mind, I say this without hesitation, that when you can mark yes to both of these, you're going to find yourself probably winning more than you lose. Sometimes you're going to break a rule. And if you don't, I don't know how you're doing it. I still break rules. But what I do is I put feedback. In my own trading, I'll put my observations after the fact when I don't have an emotional connection to the trade. What did I see? What did I do great? What did I do wrong? Let me make sure that I take some notes. And then you guys will get that feedback from me as well as you're learning to read your indicators. Hey, I thought I had momentum, but it turns out I didn't. Here's a link to the momentum lesson. And if you come back every morning and you study that spreadsheet and you say to yourself, hey, what worked, what didn't work, you'll find that the things that work do keep you relaxed. The best trades are the easiest trades, the lowest stress trades, because you say out loud, man, this pattern wins more than it loses. I can't wait to be in it. But you're also going to start to recognize the things that don't work, making you feel nervous, getting you in and out a little quicker than you should. And guys, it's this little study every morning that's going to accelerate the learning. It will prepare you for the day, focused on the best of the best and avoiding the things that are creating challenges. And all that comes from the feedback, guys. I'm going to give you everything that I have. I try to celebrate victories. I really do. I love high fives, guys. It makes me happy. But I'm not afraid to tell you if you made a mistake, because our goal is that through working together, we can eliminate those mistakes and make your trading more profitable and get you to where you told us you wanted to be. So post your trades in the room. Use that spreadsheet, guys. It is a time-tested and proven method to move forward. The high probability trend trade feels like a 2-ton anchor. It does. And it frustrates people sometimes because they say, man, this trade only happens every hour and a half. I'm not good at waiting, Mark. What's going on, man? I can't do this. There's not enough. And I've heard everything in the world. Guys, this is not your only trade. This is your first trade that teaches you to see the other trades. And once you're good at it, you go to the second trade on the plan, and now you've doubled your entry opportunities. But this one takes a little bit of the skill set that you learned here. And then you move on to other trades, and then you just create your plan because you're like, wow, I've seen so much stuff. I'm defining entries, I'm managing well, and I'm using my Nexgen indicators in a way that appeals to me, guys. And that's when you create your plan. This is what we're working towards. It's easier to get there if you start simple. I'm going to break down each rule now. We're going to talk about it individually, what it looks like, what it means to you. By the end of the day, you will have how to study it. You'll have the PowerPoint that I use. You'll have everything that you need to be successful with this software. The only thing that you won't have is the repetition it takes to make it second nature. That comes with time. So be willing to give it a little time and a little bit of work. Everything starts with the large chart, guys. Big chart leads the way. It's a big, slow chart, and it's what the large crowd wants. Large chart must have strong trigger lines. Strong trigger lines give us the advantage of momentum. Strong trigger lines, Sayed, you said it, perfect. In an uptrend, when the background is green, strong trigger lines means that your fast triggers, your small triggers, are up and above the large triggers. The large triggers do need to be wide in the direction of the trend, and it's the space that's created that defines momentum. Now, a big gap, yes, the momentum is strong, but it's not necessarily stronger here than it is here. Because when the gap is only starting, that's when they're accelerating. So rather than trying to gauge saying, okay, it's weak strong triggers, it's stronger strong triggers, it's strongest strong triggers. Keep it basic. If there is separation between the small and large guys, the odds are favorable for the market to continue up. You have strong triggers, you have the advantage of momentum. In a downtrend, small triggers must be below the large triggers. The large triggers are wide, the space is there. So you're looking for your opportunity from the point of separation until the separation is gone. And anywhere in here can be defined as odds favorable momentum. And that's the advantage that comes from strong triggers, because the odds are favorable for the market to continue in the direction of the trend. We also rely on strong triggers to help us with the potential to break those key Fibonacci areas. When the triggers are strong and the path is clear, we're using the refinement chart to buy or sell. And that's what these tails are. That's actually that refinement process that you don't see on the large chart. And guys, strong triggers, that advantage of momentum will even cover some of the mistakes that we all tend to make as new users, because strong triggers on a large chart are very difficult to stop. So keep it very simple. It's either separation or the small triggers return to the large. The gap is no longer there. There's no longer space between the two. And this is what we call weak triggers. And when I have weak triggers, anything can happen up or down. And weak triggers are when the market seems to reverse from the middle of nowhere and retrace. Weak triggers are when key Fibonacci areas are more likely to hold. So understanding and letting it be very black and white. Can we read anything from the small triggers intersect or when the large triggers intersect? So right here or right here, I want to make sure that I'm looking at the right spot. Where they cross, you want the best cheat code ever at the top. Right here. Cool. They're no longer going up. They have pinched and rolled, and now they're heading down. So your fast moving average has gone from up to down, from green to red, or it's gone from red to green. So one of the things that you can do, and I love that you're a math guy and you're going to do your best to create rules and exceptions based on every moment of the market. In order to have strong triggers, the colors must match. So don't get caught up. If the smalls are red and the large are green, simply say I don't have strong triggers. If the large are green and the small are red, as a brand new user, just say, hey, I don't have strong triggers. But when the colors match and the separation is true, that's when the first advantage is present. Will you begin to see things beyond this? Absolutely. But until you can, until you've got that repetition, until you've seen those patterns, this is your easiest path. It either is or it is not. Does that make sense? And then as you grow, here's the cool thing. This is always the best look. Odds favorable momentum. Momentum goes away, right? The small triggers return. When one line goes inside, what you're going to say to yourself is, hey, the momentum is slowing, but I'm really good at reading charts. I still might find an opportunity to go short. You might even say the momentum is gone, but I'm really good at reading charts. I have enough advantages to look for an entry, and maybe I'll take it down to Fibonacci support. But once you end up in an area and those triggers are weak, all bets are off. This is where the advantages have just left the building. So simplicity really will pay dividends in the beginning. If you keep it very black and white, what happens is you begin to notice the things outside of the basics. It's just a byproduct of your ability to see strength or weakness. Great stuff. Keep it coming. Once you have strong triggers, you've got to make sure there's nothing in the way. We call them termination conditions. And when there's none present, you will have room to your profit targets. And when you have room to your profit targets, we're going to call it that advantage of a clear path. And that just means that there's not something in the way to create a bounce. So again, large chart. Horizontal lines on a large chart. The same areas that we discussed earlier. Those fibs, divergence highs and lows, yellow one-to-ones. I like to think of these areas on a large chart. This is where decisions are made, guys. This is where that large crowd is most likely to enter, where they're most likely to exit, where the buyers and sellers associated with the large crowd are most likely to fight. Rule number 2 is designed to keep you out of their decision-making process. Rule number 2 shows you where the potential is for highs and lows, and then we're going to use the trigger lines to let us know what our reaction should be when price gets there. So the recipe for defining a termination condition, and this goes back to language being important. First, price reaches an area. We let the large crowd get to the area. Your dynamic Renko bars come up and reach Fibonacci resistance. Once price reaches an area, that sets off the decision-making process. That's where the people in control have to decide if they want to enter, exit, fight, whatever. I never know what the reaction is going to be. So I ask myself, where are the trigger lines? The trigger lines always tell the story for the brand new user. Price reaches resistance. Where are my triggers? My triggers remain below resistance. This defines Fibonacci resistance as a termination condition. And because I have a termination condition, rule number 2 is not met. Absolutely no trades into the area. And it's almost, it's cool that if the market is going down, I see Fibonacci support. I see yellow 1-to-1s, but I'm way up here. And when price reaches it, that's when I start my calculation. That's when I ask myself, where are the triggers? My triggers remain above support. Support is a termination condition. Absolutely no trades into the area. In a live market, it's going to look very much like this. You're going to see price hit that area. You're going to ask yourself where the triggers are. And the triggers tell you, hey, pump the brakes. Wait a second. Let's see what the reaction is rather than try to predict it. And guys, these areas are amazing. From resistance to support, resistance breaks, behaves as support, resistance, divergence, hides, hold. That's where the market starts pushing down, and it's bouncing right off of support. And guys, we know where all of these are. We just have to go through that idea of how to calculate. And there's 3 things that happen every time the price reaches an area, guys. It either stutters from a fight, it reverses completely, which happens a lot, or it breaks. And if they didn't break, we'd be stuck in a range forever. So this is what it looks like when an area breaks. And I like to talk about this because when the market has a lot of push behind it, that's when these things break more often. Number 1 here is price reaches Fibonacci resistance. The triggers are still above. This is a termination condition. And I'm just waiting for the reaction, guys. I'm sitting on my hands. This is part of that 90%. Doing nothing. I'm playing solitaire, and I'm saying this either has to break or it has to reverse. Well, if it's going to break, my trigger lines tell the story, not the price bars. The small triggers are going to make it through first. But those large triggers, those slow-moving averages, they tend to lollygag. They lag behind a little bit. And when 50% of your trigger lines are through, but 50% are not, guys, this is your second trade. This is your medium probability trade. That strength, that trigger location says this blue Fibonacci support has the potential to break, but it's not broken yet. We consider an area to be broken when the small triggers and the large triggers get below support, or the small triggers and the large triggers get above resistance. That's what offers the clear path. For the brand new user, we're relying on momentum and we're relying on clear path. And this is the easiest way to get where you want to be. The easiest trades that you'll ever take will have not only momentum, but price will not have reached an area. Price will be clear of the previous area. And you're kind of floating in between Fibonacci areas, guys. This is the best of the best. This is where trades typically run fast, where the profits become the easiest to take. With momentum and path, these tails represent the potential pullback on a smaller, faster chart. You're going to be able to pinpoint with that refinement chart where these tails are most likely to form. So you can allow it to be easy, understanding that one day you'll be able to complicate things and see more, but this is how you're going to find the highest level of success most likely as a brand new user. And these are large charts, guys. These are large chart endeavors. We looked at it on crude oil. So on the most current bar on crude oil, I'm just going to take a snapshot here, and I want you to see how the large chart read goes. First, I say the background is red, therefore the market is going down. They don't show the fib levels. When you say the fib levels, are you saying you don't have red Fibonacci resistance? You don't have blue Fibonacci support? Can you show me a picture of your chart? Are you comfortable taking a picture yet? I want to see what you're working with, and I can probably help you fix it. Here, even before the picture, Syed, do me a favor. If you don't see them, maybe your chart looks like this. And you're like, man, I don't see fibs. Look up here and see if there's a capital F. This is a scaling tool, and when you click F, it'll bring everything back into view. Sometimes, and I've done this before, my market is way back here, and I'm like, gosh, it's just gray. Click the arrow, and that brings it back. See if that's what had you. I used to wake up in the morning and the market was trading someplace else, and I would just, oh, where is it? Where is it? Where is it? Where is it? And I'm like, I don't have any indicators. My software's broken. If you just click that F, right back. So hopefully that's what's going on. If not, we'll go to the next step and see what we can do. But this is our large chart read, guys. In the moment, what color is the background? And I'm gonna write this out for you. This is my large chart routine. What color is the background? Red is down, green is up. Looking for rules to trade with the trend. And then I say, do I have strong triggers? And when I look over here, I see the small triggers are below the large triggers. There's space between the two. And I can answer without question, yes, I have the advantage of momentum. And then I have to ask myself, do I have a clear path? Let's do this. If it's yes, go to rule number 2. If no, stop looking and wait. And then rule number 2 is a clear path. And the recipe is, did price reach an area? It absolutely did. Did the triggers get below that area of support? They absolutely did not. That's a termination condition. And then once again, the highest chance of success for new users, if it's no, stop looking, no trade. And if it's yes, go to the small chart and look for an entry. So it's like a flow chart. I start with what color is the background, and then I go to strong triggers. And if strong triggers is a yes, I go to the clear path. And if clear path is a yes, guys, I'm going to go look for an entry. I'm going to get off the large chart. The large chart has done everything that I need it to do. And for those of you that are just now learning the software, let me show you how effective rule number 2 is. And 1, really. Weak triggers, rule not met, no reason to go long, avoidable loss. Price reaches support, triggers remain above, no reason to go short, avoidable loss. No momentum, no reason to go long, no reason to go short, termination, 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 termination. Guys, crude oil is caught in a range. Oh, that's an interesting look. All right, so let's try this. Your trigger lines are working, but we're missing some stuff, Syed. So I want you to right-click on your chart for me. Sid, you have no lines either? Okay, so guys, the server was down this morning. Let's try this first. Close down your NinjaTrader and reopen it, because they had to reboot the server, which means you guys probably need to reboot NinjaTrader. So save your workspaces, close down NinjaTrader, reopen it, and let me know where you're at with it. Cool? That should get you guys taken care of. And just a reminder, while I'm not the tech guy, I've broken an awful lot of stuff. But if I can't give you a little insight on how to do it, where the heck is the tab? Go to Jason and Tech. Let Jason rock it out for you. But a lot of times, just that reboot's going to get you where you need to be. Is that good? You guys see how rule number 2 keeps you out of a loser here? Do you see how rule number 1 keeps you out of a loser? This is what I want you to embrace as new users. That it's okay to not be in a trade. Never seen fib lines on your charts? Okay. So, Syed, try this for me. And Sid, you can try this too. Right-click on your chart. Go to templates and load. And load on the large chart that 13.2 Renko bar. So this is your large chart template. And this is your small chart template. Yeah, we want you to have those fibs. Those fibs are freaking amazing. That's where the advantages come in. So close the charts so you don't have it up. Okay. Did you close NinjaTrader as well? So close NinjaTrader and reopen it for me. And then when you reopen it, let's see if it recalculates things. It should. If it doesn't, Syed, I want to get you with Jason and Tech and let him make sure that you're solid, because I want you to be able to see these indicators, because that's where the advantages come in. I'm sorry, Joe. What do you mean connection? Help me out with that. That's... Guys, the server was down this morning, so you may need to reboot Ninja. Oh, I know what Joel's saying. Yeah, he is connected. He's got prices, and he's got triggers, I think. So guys, all right. Everybody stop fiddling with their charts for just a second. Close your workspaces. Close NinjaTrader. Open it back up. Because when the server goes down, guys, and you don't have indicators, you've got to, the same way the server rebooted to get everything going, you've got to reboot your Ninja. So try that for me. Please, please, please. And if that doesn't bring it back, if you don't have fibs, triggers, all the stuff that you're supposed to have, guys, I want you to get with Jason and Tech, because it may be something going on with your computer. But let's do the easy fix first. Let's do the, hey, even Mark might be smart enough to fix this first. Reboot Ninja. Close it down. Open it back up. It worked, Sid. Awesome. Beautiful. Let's get back to termination conditions, guys. When I have momentum and path, I'm going to go look for an entry. There is one termination condition that can happen on a small chart. Jared, make sure you let me know if yours worked. Syed, let me know if yours came up. Mark Dean may be calling you, because if you haven't had them yet, that works. Not working? All right, Jared, show me a picture of your charts, please, my friend. All right, Victor, show me a picture of your chart, please, my friend. They're blank. There's absolutely nothing on them at all, Jared. Are they red and green? Absolutely, they are red and green. Do they look like this with nothing on it, just colors? If so, okay, they're gray. Thank you. That's what I needed to know. Victor, it looks like you have everything, brother. What's the challenge? You can't see the F? You can't see the F, my friend, because you're scaled right. There we go. That's a good one. The F only shows up when you go out of scale, and that brings it back. So you won't see it. You won't see the arrow either. If you're not pushed one way or the other, see how the arrow shows up, but when I click it, it goes away. When I click the F, it goes away. So, Victor, you're just perfect, my friend. Your charts are exactly where they need to be. And you can see the most current bar. And guys, you know it's the most current bar because it's highlighted in black. All right. So Jared, you're blank. Will you please close down NinjaTrader, open it back up? Did you try that already? And that didn't work for you. Um, awesome. Jason's gonna get you squared away. And I'm not sure what may be going on with that one. I'm good with the simple fixes, guys. Sorry. Are you connected to your live data? Man, Jason's amazing. He really is. Check your data connection too. See if that's in. Um, and you can try that right click and load a template back on. So on your large chart, right click, go to load templates. Just for grins, you have a ticket in. Try to reload that 13.2 because there it is without it. And as it calculates, it begins to come through and put those indicators in. So I would try to do that one. Ron, if it says update available, take it. It worked for you this morning. Right on. Guys, I'll do everything in my power to help you with the tech stuff. Sometimes I just run out of talent. We got to give it to Jason. The only stuff he can't fix are the things that aren't broken. Let's move on. 3 divergences in the same price range, guys. This is the only termination condition that I want you to accept on a small chart if you have odds favorable momentum and a clear path. If the rules are true for the high probability trend trade on the large chart, this is the only time it's going to talk me out of the entry on the small chart as a brand new user. 3 divergences in the same price range can terminate a trend. 3 divergences means that the sellers were pushing down and the buyers stole their momentum 3 times. And this is your small chart giving a heads up that things might be changing on the large chart. But if everything is good, if I can define the trend, establish momentum, recognize a clear path, we're going to go to the small chart, the fast chart, the refinement chart. And we're going to use a limit order to buy or sell a pullback at an area inside of triggers. The limit order lets you know just how accurate this entry can be. You're going to wait for the market to come to you, and you're going to wait in an area. And an area can be a fib, it can be a mid-band, it can be a yellow 1-to-1. The same way areas on a large chart can stop the forward progress of the market, the same way areas on the large chart can create reversals and bounces, they do it on the small chart as well, but they do it in a smaller capacity, and very often that bounce is in the direction of the underlying trend. But here's one of the key concepts. You want your areas to be in triggers, guys, because large triggers, slow moving averages on the large chart or the small chart, you're going to use those to define the retracement zone. You're going to use those to understand where that little retracement is most likely to go. So you're going to have large triggers on your small chart that are first from the small chart. These are the small large triggers. You'll use them with the fast triggers, and you can define momentum on a small chart using small and large. But you also have an additional set of large triggers, and they have little steps on them. These are what we call the synthetic triggers. The synthetic triggers are the large triggers from the large chart. So one of the things that happens each and every day in the market is price tends to accelerate away from large triggers, and then it returns to the large triggers. And you see this over and over. So one of the things we can do is we can use those trigger lines. We can use those trigger lines to define where the retracement is most likely to occur. And that's going to help with accuracy. That's going to help reduce risk. That's going to help getting you in at the absolute best of the best spot. Guys, give me just 1 second. I need to give Chris something real quick. There we go. He's making awesome study materials for you guys. So price returns to triggers, guys. We're going to use that concept to define retracement zones and, more importantly, to provide accuracy for entry. So here's how we're defining entries, how you're defining entries. When the rules are met on the large chart. In this particular picture, the large chart will be green, the triggers will be strong, the path will be clear. When the rules are met, your small chart is going to be screaming up, guys, and you're going to have that fear of missing out. Worried that it's going without you, worried that you're not going to get an entry, that you're not going to find a way to get paid. You're going to patiently wait for a reversal bar, and a reversal bar means you got a red bar after all of those green bars, and the reversal bar signals the beginning of the pullback. That reversal bar is showing you that the small crowd is fighting. Once the reversal bar prints, or with a little bit of study even before it does, you're going to say, all right, somewhere from the top of the large to the bottom of the large, that's where this retracement's most likely to go. That's where the down bars are most likely to go down. But trigger lines are not entries. Trigger lines just define retracement. It's the areas inside. It is fibs, midbands, yellow 1-to-1s. It's a short list. Fibs, midbands, yellow 1-to-1s. One is not more important than the other. But these are the areas most likely to create a bounce and send the market off in the direction of the large chart trend. So you're going to create a window. And the window is I call it the window of opportunity because I like to be positive. The window is saying, all right, if they push down, they're going to bounce either from this midband, if this is going to be a winner, or they're going to bounce from these yellow 1-to-1s, if this is going to be a winner, and they may even retrace to the very bottom of the retracement zone. But this is where it's most likely to bounce. So you're going to activate a limit order just above the highest point of support. And you're going to say, because of the momentum on the large chart, because there's nothing on the large chart to create a bounce, I'm going to get in high. I'm going to get in at that top level, closest to the reversal bar, because I don't want to stumble over a couple pennies trying to save a few bucks. And anything below the retracement zone, anything below the area is most likely to create a bounce. Guys, this is outside of your window. That's not part of the entry equation. And once you get to what I call the wrong side of the trigger, so if you're trying to take a long trade, the wrong side of the triggers means the market has pushed down below the areas most likely to create a bounce. It has pushed below where the retracement was most likely to occur. Once I get to the wrong side of the triggers, guys, I don't know if, when, or where that market may continue up. This is where the advantage of rule number 3 is no longer in play. You're going to learn to ignore those lines on the wrong side of the triggers. For a short trade, large chart says down. Large chart has strong triggers. Large chart has a clear path. Have I mentioned that the large chart rules should be met first? This small chart's like a siren song. It'll talk you into some nonsense if you don't have those large chart advantages. We wait for the reversal bar, but the reversal bar is not the entry. It signals the beginning of the pullback. Where's the pullback most likely to travel? Somewhere from the bottom to the top of the triggers. Where's it most likely to bounce? At an area inside of triggers. One line, guys, mid-band. That's it. Your window of opportunity is one tick wide. You're going to activate a limit order, a tick or two below it, and you're going to say, come get me, small crowd. Understanding that anything on the wrong side of the triggers is where the market should not go. You're going to use that concept for your initial stop placement. One of the things that we talk about in the first hour is we focus on 3 advantages heavily. And we turn those 3 advantages into a high probability trend trade entry. And we don't even talk about management until we define where the market is most likely to continue. But you really are. You're working on management by having momentum. And you're increasing the likelihood of success, managing your losses before profits with a clear path, and defining the entry. Your initial stops, guys, and this is in the plan that I give you, will be placed 4 to 5 ticks beyond the triggers. This is where the market should not go. And that, that location is where the advantage is no longer present. That location is where the market has made it through everything likely to create a bounce. That location is where you are going to accept that anything that wins 70 to 80% of the time is mathematically obligated to lose 20 to 30% of the time. This is acceptable losses. This is the cost of doing business. And guys, you're going to be on both sides of the coin as a day trader. I've never met a day trader that wins 100% of their trades. But with accuracy, you can minimize losses dramatically. So we've talked about momentum, we've talked about path, and we've defined entry. This is your pattern putting it all together. This is how you're going to study this pattern. I hope you go back and study this pattern. I actually hope you go back and study this pattern trying to prove me wrong, because you'll probably end up with me forever. If I scroll back historically, and I'm looking at a large chart, and guys, this is a range-bound market before crude oil inventories, I'm going to scroll back and I'm going to look for odds favorable momentum, and I'm going to define a clear path. And crude oil has not been playing real nice, but here we go. On a big chart, if my large chart has strong triggers and at least the potential to break, guys, if I see one of these tails, I'm going to circle it. And I'm going to scroll back, and I'm going to be able to do that throughout the whole day. Tail into momentum and a clear path, and I'm going to circle a tail. And this is how you're going to study. The rules have to be met before I circle a tail. What I can do is I can go back and look at these tails on a smaller, faster chart and ask myself, did it pull back to an area of support inside of triggers? Do you see it? Large triggers are strong. Area has the potential to break. That tail isn't what we're trading, guys. That tail is a pullback to a mid-band inside of triggers. And guys, it created an opportunity to make a little money before it started dancing. If I scroll back to the next one. Tail into momentum, 100% clear path. And guys, this one made its way up to where the market shouldn't go, and you'll notice that it did it with 3 divergences in the same price range. So I say not my trade, and I scroll back. And this one, absolutely beautiful. Momentum, path, pull back to an area darn near to the tick, and look at the push down. So what we're learning, guys, isn't necessarily every trade that you can take. We're learning the highest probability trend trade first. So this is what it's going to look like on a large chart. Does everybody see it? Separation between the small and large. All of my triggers are below this fib, and I haven't yet reached this fib. This is the perfect look on a large chart to go look for an entry. Do you guys see it? New users, it takes a little study. Color, triggers, path, in that order. It's a flow chart. When it looks like this, a small chart looks like this, and it's probably screaming to the downside, and I'm waiting for a reversal bar. And once I get a reversal bar, I'm going to go through that process. Where are these bars most likely to return up? Somewhere from the top of the triggers to the bottom of the triggers. But what's most likely to create a bounce? An area inside of those triggers. And where do I put my limit order? I'm going to right click on a chart, and I'm going to activate a sell limit a couple ticks below that mid band, and I'm going to hold my breath and hope it gives me an entry before I pass out, because I've done everything that I can do. But if they come back and they hit my entry, I'm going to short trade, guys. I'm going to short trade with momentum. I'm going to short trade with a clear path. I'm going to short trade right at the area inside of favorable large triggers, and I know exactly where my stop goes if this is going to be one of those good ones that win. And look what the market does with all that momentum and path right off the area inside of triggers. And guys, if I take a minute and I put this box around the high point of that move, you'll see that it lines up with the tail on the large chart. We don't trade tails. We trade pullbacks to areas inside of favorable large triggers. And guys, that's your high probability trend trade. That is the best of the best. That's the trade with the highest chance of success. That's the trade that creates confidence. That's the trade that's going to teach you to read your indicators. So what you can do is you can expedite the process of becoming a chart reader, and you're going to do it with pictures, guys. The goal is that you first look at your large chart, you identify momentum and path. This is your core. This is your foundation. This is what you're going to grow from. These two concepts open the doors for more opportunities. So take 25 pictures each and take the time to explain in your pictures. Strong triggers, weak triggers, clear path, termination. Take those pictures, take those annotated pictures, drop them into your spreadsheet. Come back and study them a little bit every morning. Because what's going to happen is that if you take 25 pictures of strong triggers and you take the time to write, smalls are green, large are green, background's green, smalls above the large, both wide up, space between, strong triggers, odds favorable, momentum, rule number 1 met, you're not going to mess up that look. You're not going to make a mistake on strong triggers believing that it's weak triggers. The same is true with path. And guys, what you're doing is you're creating this recognition, and you're doing it through the pictures you're taking. And then once you understand those first two advantages, you're going to be able to go find the others. I'm also going to give you this. This is the high probability trend trade checklist. It is each of the rules met, what it looks like while you're taking the pictures, and it strings it all together to create a checklist that gets you into the market. The checklist doesn't do anything to manage your trades, but great entries create very manageable trades. These are the same things you should be writing on your chart. When you take a picture, you may not be able to write yes, but you should remind yourself that I'm looking for odds favorable momentum, that I want to make sure there's no terminations, and I love the language here, areas inside of favorable large triggers. Nobody's ever been able to mark yes to all 4 of these and do worse than 70% in the history of the checklist, which is why this checklist is the core for the KISS plan. And this is the plan that you're going to have as a brand new user. This is the plan that's going to frustrate you because you don't seem to be taking as many trades as you think you should. This is the plan that's going to make you patient. This is the plan that gives you the opportunity to win more than you lose as you learn to read your indicators. So, guys, this is a stepping stone. This is the first. This is not the end of the road for you. This is the one that's going to teach you to see more. But this plan is designed to optimize your chances of success. This is the best of the best, using that high probability trend trade. It will be through simulation, study, class feedback, and continuous practice that you will be able to create your own plan, that you will be able to write your own plan, to see things, to do more. And there's 2 things you have to know before you sit down and you're not on simulator, guys. And this is why participation in the class is so imperative. The classroom is designed to tell you what you're doing well and what you're doing wrong, because as a new user, you can't possibly be expected to know the difference. Get that feedback. Use the coach. Why will I enter a trade? I call this the Sunday school answer. Because my rules are met. That should be the only reason that I ever enter a trade, because my rules describe a pattern. That pattern can be proven to win more than it loses. I'm going to take the time to prove that this pattern wins more than loses, which means that I will go into every trade with the understanding that I don't know the outcome, but because it is a pattern that has been proven, I have an edge. It's more likely to win rather than lose. And when I understand that I'm not in control of anything other than my rules being met, it really pulls a lot of the emotion out of trading. I also have to know why I'll exit. The best reason to get out of a trade is because you reach your profit targets. You'll be able to define profit targets using fibs, momentum, stuff like that. That takes a little time. The other reason is when the advantages that get you into the trade have gone away. So if I no longer have strong triggers on a large chart, I might manage a little bit. If termination conditions show up on the large or small chart, I might manage, I might exit, guys. If the market pushes beyond those triggers, I'm going to manage and take a loss. That's okay. It's a normal part of a positive equity curve. Until you can read all these things quickly, accurately, making sure that you can recognize those advantages when they're present as well as when they're gone, guys, I'm going to give you a plan for management. Your management plan in the KISS plan. Guys, it's 2 contracts. And these 2 contracts each have a very specific role. And I wrote this plan for management because management scared the ever-loving snot out of me. When I was a brand new user, I was terrified to lose and I didn't know how to win. So the KISS management plan is designed to do 2 things. Trust stop placement, recognize where the market shouldn't go. But guys, it's focused on getting you paid. It's so easy to forget. That's why we're here. That's why we're becoming day traders. So we don't have to go back to that 4-letter word, work, so that we can make money in our underwear, so we can golf 5 days a week, guys. So this plan is going to help you trust stop placement. It's going to focus on getting you paid. And you will have the ability to create your own management plan based on your ability reading the indicators. But until you can do that, it's okay to keep it very mechanical. And I wrote this to be 100% if then. If entry is 2 ticks below resistance inside of triggers, then my initial stop is 4 to 5 ticks beyond the triggers. This is where the market should not go. You will know your risk before the trade is ever entered. I encourage you, accept the risk. Because this particular trade, crude oil, if I enter at 71.34, 71.49 represents $150 worth of risk per contract. If that's too much for you, if you're like, I'm only willing to risk 100, and you put your stop in the retracement zone, you put your stop at the areas likely to create a bounce, well, then the odds are favorable that you're going to get stopped out only to watch that market run. So I encourage you guys, you're on simulator, let it play out. Put your stop where the market shouldn't go. Initial targets are $100 and $200. That's it. We're learning how to get paid. If they don't stop you out, it means you got a reversal bar in the direction of your trade, guys, and you're going to redefine where the market should not go. Your new stop will be 2 ticks above that reversal bar. We're redefining where the market should not go because this reversal bar represents a confirmation that the market is now doing everything your indicator suggested that it would. There's no reason to keep the elevated risk on there. You're at $30 risk per contract in this trade. Doesn't guarantee a winner, but it guarantees a much smaller loser in the event that things go back up. If they don't take you out for that tiny little loss, it means that they ran to your first target. Guys, when you have momentum and path, this first target tends to be pretty easy to reach. And if it reaches it, 1 contract is pulled off. And those funds go into your account. And with 1 contract remaining, you're going to move your stop to break even. You are now a successful day trader, and you're feeling confident because of that success. Great entries create manageable trades. You have 0 risk on a trade and funds in the account, guys. And this is where the second contract creates trust. Because with nothing to lose and money in the bank, you're reminding yourself, the only reason that I took this trade is because that big, slow, hard to change chart says down strong with nothing in the way. And it is more likely to keep dropping than it is to just turn and reverse. And it's more likely to hit your second target. But your second target is only $200 away from your entry, guys, which means over the course of a couple minutes, because of momentum, because of path, because of well-defined entry, you just took a $300 trade. Couple minutes of your trading day, guys. If that's the best you do every day, it's a $75,000 year. Throw in $100, you're at 6 figures. The goal is to get paid. Your account doesn't know if the $500 for the day was from 1 trade or from 10 trades, guys. The only thing is that consistent profits reach goals. Awesome, Jared. I'm glad to hear that. And as you grow and as you learn and you understand more, guys, the potential for higher rewards is there. One of the things that I love about what we're doing with this funding company, and there's trading copiers, guys, find a way to make $100 consistently every day. Just mirror it on 10 accounts. You're making $250,000 a year based on 1 trade mirrored on other accounts. The potential for more is there, and it all stems from consistency. So you're going to get right now everything that I just talked about. I'm giving you a zip file. It's called All You Need. And inside of that file is everything that I've presented. It is the PowerPoint that I used to teach. It's the very basic instruction, guys. It's recognizing advantages. And there's the spreadsheet one more time. This is my first hour, and it's an hour and 13 today. Every day, I say the same thing because when you build this foundation, guys, life gets easy as a day trader. I really believe that. But I'm going to share this before we go to the second hour, guys. The key to everything is having a foundation, understanding some basics. This is why I encourage you to keep it simple, and then compounding, growing just a little bit from those basics every day. You're on a marathon. So for you brand new users, I blanket you with very conservative rules. We talk about recognition of advantages, and I hand you a solid plan that optimizes your chances of success as you learn to read these indicators. So for you new users, it will feel like all terminations are bad. No momentum is horrible. Areas beyond the triggers is the kiss of death, guys. And these blanket rules are there to increase the likelihood of success. As you grow with the software, you're going to realize that they're not always bad, that there's ways to work around them, that you can gauge things using advantages and know when it's okay to use exceptions. That comes with the time you spend with it. So the goal is to learn the process that yields the results. Learn how to make money easy first, and then you can expand. And this is where the KISS plan comes in, guys. If you can keep it that basic, if you can follow the simple rules, and most importantly, if you're okay not looking for all the trades, give yourself 20 trading days, your first 30 days of Nexgen. Look for the best trades. You can find an extraordinary level of success. I've watched it. The further you deviate from simple, the longer you take to be comfortable with patterns. So question everything. I want you to question everything, but I want you to give yourself a little grace. We are brand new. It's okay to be brand new. Guys, one of the things that's going to happen in the second hour is you're going to see people taking trades that don't fit the rules that we just talked about. You're going to see people fighting trends. You're going to see people trading without momentum from areas beyond. They're doing this because they're at their point in the trading where they're comfortable making exceptions. Their plans have changed. But what I'm going to do in this classroom and what I do when I look at your pictures, guys, is I'm going to talk about the momentum that I see on the chart, and I'm going to compare it to what you told me about the momentum on the chart. There will be times when we will disagree. If we disagree, I'll tell you why I disagree. I'll show you examples of why I disagree. Everything is about chart reads. It's not about being right or wrong. It's about accuracy. If you tell me that you had a clear path, but it was only potential, we'll address it, we'll cover it. How do I recognize that it's only potential? The same is true with entries, exits, guys. So I want you to tell me what you see. I want you to tell me why you did what you did. And your trades don't pay my bills. But my job is to help you read your indicators so that you can make good choices. So there will be times where I tell you that your reads are wrong, that you made a mistake, that you got lucky. I need you to be okay with that. There will be times where I will discuss and address the language on your chart. If you tell me that you see something, but that's not what it actually is, we'll talk about it, because I don't want you hyping yourself up, believing you have momentum if it's weakness, or believing you have a clear path if it's not. You erased your stop loss, Victor. Man, we just can't have nice things. Go over to your ATM strategy and hit that drop down, and you should be able to put it right back in. Or did you erase it in the moment? Did you exit out in the moment? I want to make sure I understand what happened. I'll show you a cool trick. If I don't have my ATM strategy in, if I don't have my stop loss in, and let's just say hypothetically I go long, and now I'm in the market and I don't have any protection. Well, the opposite of buy, going long, is sell. I'm going to right click below and I'm going to put a sell stop market in. And what it does is it puts in those two contracts, and I can put it where the market shouldn't go. And I can do the same thing for my target. Well, it just hit my stop. So if I try to go long again and I don't have an ATM, I can click above and I can just put a sell limit order in, and now I have a target as well. I've done that where you hit the X out. So if you're in a long position, the opposite is sell, sell stop. And now I've got stops and I've got targets in. If it hits my target and I exit the trade, I have to remember to cancel out the other side though, Victor. It won't automatically go away. And it stinks when it puts you in a short position you shouldn't be in. And guys, these are the things I think you should practice every now and then. These are the things I think you should go through, and you should get in and you should get out, and you should forget to put a stop in on purpose so that you know how to fix it in the moment. Everything that you learn as a brand new user on Simulator is going to make it easier when you go live. So, great question. Um, you chill for now. You'll share this trade. I think I did good. Looking forward to the feedback. Cool. So, Victor, when you show me your picture, I want you to describe the momentum that you saw. I want you to tell me what you thought about the path, and I want to make sure that you show me your entries, okay? And I'm not gonna go after right or wrong. We're gonna discuss advantages. That's it. Is it a pattern that you can prove wins more than it loses? That's my goal every time I look at one of your charts, guys. So I'm gonna go stretch my legs. I'm gonna take a break. If you have questions, please post them in the room. If you have comments, post them in the room. If you need something specific, post it in the room. Guys, this classroom becomes amazing the more you participate. The more you sound off and tell me what you need, the more likely you are to get what you need. So I'll be back in about 5 minutes. Go stretch your legs, and then we will get into chart reading and everything that you guys have posted. Back in a few, guys. All right, guys, second half of the classroom, nothing but chart reads, talking about advantages, looking at trades, doing all the stuff that we do. Encouraging you guys, if you are making a transition to TradingView, if you're using TradingView indicators, if you're trying to trade the TradingView plan that Nexgen provided you and you need feedback on your charts, please share those in the room as well, guys. I want to give you everything that you need. I want to make sure that nobody gets left behind, that we cover all of the things that you need covered. I'm going to scroll up to the very top of the chat box, guys. It takes me a minute to go back and forth, so I will click on multiples. If I miss a comment, if I miss a picture, I want you to make sure that you let me know. I never intend to miss anything. Wayne got us going today, and Wayne says, check it out, Mark. I have strong triggers. I'm getting above all the areas. I have momentum on 3 different charts, and this is one of my favorite things, guys. Wayne says, I want you to see this. I can get into this trade, and I can exit this trade quickly, $110, because this is a trade that is based solely on momentum, and his expectations for big moves are a little smaller. Guys, this is a trade that was designed by Ron C. It's called the Chili Dog, and it relies on momentum and path. And it says, let all of price action get away from decision-making zones and ride momentum for quick, easy to pocket profits. Wayne, absolutely perfect execution. And then over here, termination condition, and Wayne takes the first shot at it. Says 2 trend trades. The first trade, everything is into resistance, right? And he says, well, let me get a little above that fib, coming from a termination. And this first one's just kind of a let me ride small chart momentum after a termination, see if I can make a little money with it. And then the large chart catches up, plays along, and Wayne says, look at this, quick little snapback, right to a fib, right in a trigger, easy money. Wayne putting on a display this morning, really nicely done. He says he just jumped the fudge in. JTFI, that's what that means. I jumped the fudge in. Well, Wayne, why did you do it? Well, because, Mark, I had odds favorable momentum on 3 charts and room to a fib. And with strong triggers on 3 charts, Wayne says, yep, I'm going to jump in and I'm going to get paid. Nicely done, Wayne. Odds favorable, strong triggers, and clear path. And let's see where he went short. And I'm not sure that he did. But all these white bar shenanigans kept me out. So he's looking at it, and he's thinking a trade, and there's multiple divergences, and Wayne says, and this is one of the things that's brilliant. Wayne says, I don't have the advantages I need to feel like risking my money. My chart read says, okay, this is strong. It has the potential to go down, but that big, ugly blue fib and all of these shenanigans say, just pump the brakes, Wayne, and the next one's coming. Awesome patience. And that happy moment when you realize you forgot to close a buy order. It's nice when it works for you, and that's a trading view chart. Nicely done. Wayne, great trading. Guys, everything he did was based on momentum and path. A little unorthodox if you're comparing it to the high probability trend trade, but everything he did was based on momentum and path. And that's kind of what I want you to get out of this. I want you to recognize, to accept, and to see that when you have strong triggers, when there's nothing in the way, you will find a way. You will find a way to capitalize using this software. Pete, oil inventories in 2 minutes. Awesome. No worries, Wayne. There we go. It was all praise. Your issue is Ninja Navigation. There's over 400 in profit, not knowing what I did. Victor, will you show me 2 charts and just tell me why? Just say why. It doesn't matter. There is no right or wrong. I promise. But when you go to take that picture, if you show me the large chart and the small chart, what it does is it gives me the opportunity to know where you did what you did. This is a large chart, And your large chart, check it out. It had a strong bottom. It had odds favorable momentum. I want to see your great entry at 66.53. Large chart looks awesome, Victor. So what was going on at 66.53? It was somewhere right in here. Did you get in on that little pop back to the areas inside of triggers? Uh-oh. No, you're okay. So what I see is at 60.53, it looks like you probably got in. Whoops, that was wrong. You probably entered this market somewhere right about here. Oh, that's the S&P. Never mind. I'm looking at the wrong market. So let's go to crude oil. Strong bottom, odds favorable. 53. Here we go. All right. So let's break it down into the three things. And you're in way above. So this doesn't show me your entry. I need you to click, and this is okay. We're learning to navigate, Victor. I need you to click, whoops, sorry, the black arrows. Because it looks like you're actively in a trade. I want to see your entry, but let's look at this chart real quick and let's talk about it. Do you see right here where the smalls are above the large and it has potential to break? Right where you put your yellow box, that's your entry, 66.35. That's where we're going to try to get you to. This is where the risk is the least, and you have the most room to get up to trouble. Does that make sense, Victor? So large chart, we're going to use the yellow box because this one wasn't quite in the rules. So you had strong triggers. The fibs had the potential to break. And this was your pullback to an area inside of triggers. So your entry was right here, but you actually got into the market up here. So what we're going to figure out, do you recognize this is your entry? You saw it, thought about it, and then hit buy, and it gets you up here? Because that's pretty typical for new users. By the time the thought process is done computing, you find yourself in a little late. And that's normal because you're working through the process of making it easy so that you can recognize it quicker. Does that make sense, Victor? This one had the least amount of risk. This entry is kind of catching the second part of it. And closing your stop loss and open another 2 trades. Okay. So give me a Y or an in. Do you recognize that your pullback to an area? It's okay. You're learning the navigation. You're going to do this 100 times. And Victor, I'm going to tell you what else you're probably going to do. You're going to go to buy the market and you're going to accidentally hit sell at least once. We've all done it. That's one of the great things about Simulator. You're not just learning these patterns, man. You're also learning how to use that platform so that you can execute. Pull back to an area is your entry. And that's the part that I want to make sure that you understand. That with this look, that's where the proper entry is, right? And I know that you're working through some hiccups. This is awesome, dude. Everything about it is great. And I know that, and you said that you closed it and then re-entered because of the stop loss. No worries. And it put you in up here. So you probably did a little and made a little. Does that all make sense? And this is what we'll do every time. We'll look at the large chart and gauge what's going on. And we'll look at the small chart and see where the entry could have been, where the least amount of risk, where the highest profit potential. And if you entered here at 35, you could have exited up here at 48, right at trouble. Yeah, it's just repetition. But I'm going to say you're on a good path, and I'm going to feel comfortable saying that because you're following the large chart. Your entries are following the advantage on the large chart, and that's the goal for new users because that's how you end up where you want to be. Great stuff, Victor. Nice work. Let's keep doing it every day until it gets easy. All right. Mr. Paul says, check it out. It's a strong bottom. It's odds favorable. It has the potential to break. And Paul says, man, I'm going to get in right at Fibonacci support, and I'm going to ride it up. And the only thing is maybe the entry was a little bit higher, and then it pulls down and goes up. But guys, large chart leads the way. Odds favorable, potential to break. And there's your HVA to help confirm entry. And you have terminations on every chart, Paul, which makes it more likely to go up than down. With odds favorable momentum, you just jump in. Totally cool. The market is screaming and you jump in into the fib. And what you'll find, Paul, very often, I love this trade. Just let it get above trouble instead of trading directly into trouble. Very often, this is going to reduce the likelihood of that bounce. And I know that you have tight stops. And it'll keep you, because look how the fib created a bounce. And then you're catching it on the way up, which I think is brilliant. Really great job. Everything is up. And you're catching it on the way up. And what you're seeing here is the sellers right at a key area tried to push, and the buyers squished them instantly, and you caught that. Nicely done, Paul. And then second divergence lower than the first with nothing in the way above. I didn't take the long because the 21.3 and the 13.2 were weak triggers at a bunch of resistance. I love it. Don't have a clear path. Don't have an area inside of triggers. Trouble everywhere and weakness. And Paul, you say, because I can read advantages, I choose not to take the trade. Nicely done. That's the hardest thing, guys. It's so easy to pull the trigger and get into the market. It's so hard to sit on your hands and do nothing because you don't feel like hoping it goes up or you don't feel like hoping it goes down. So, Paul, gold star coming your way today. I'm going to scroll up and let's see who's next. Guys, I'm excited about chart reading today. Keep them coming. And remember, I'm scrolling up a lot, so if I miss your picture, please, 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 don't let me get away with it. I never do it intentionally. All right, Pete, we've got 4 of them from you. This turned into a sweet trade, not a strong top, as price didn't reach the fibs. Triggers rolled down and separated. Odds favorable momentum blasted through all the terminations to a clear path. So Pete takes the jump in trade. And this is a pretty cool, this is a cool lesson. And guys, I'll turn some of your charts into lessons, even though maybe you don't even want the lesson. Pete jumps in. So when Pete jumps in, Pete is saying, because of all the momentum, I'll jump in and hope for the best. And that's a good reason to jump in and hope for the best, not going to lie. Well, when Pete gets this reversal bar, his advantage is gone. The advantage of momentum is no longer present. And Pete has to make a decision. And what Pete says is, okay, this one isn't going, but it's pulling back to the perfect trend trade entry. When his momentum trade fails, it just turns into a beautiful trend trade. And Pete says, I'm going to hold my position, and then I'm going to add on at the areas inside of favorable large triggers, and I'm going to ride that momentum down and make a little money. So one trade turns into the second trade. The first trade, the advantage was momentum. The whole reason he gets in is momentum. The momentum doesn't go away on the large chart, but it does on the small, and it turns into the perfect trend trade. Pete, this is awesome chart reading. And guys, this is where you're headed. If you decide to just jump in and it begins to fail, you may have another option. And when you can read your indicators quickly, it becomes easier to see. STM, strong trending market. So if your market goes 30 bars in the same direction without a reversal bar, ladies and gentlemen, we define that as a strong trending market. It is pushing hard in the direction of the trend. When you have a strong trending market, you'll notice that the small triggers will ride the outside of the large. So you'll go from strength to weakness to piggyback. Piggyback lets you know that momentum is implied. There's Pete's first trade. And Pete says, I don't want to trade into Fibonacci support. I know this is an area that could stop the market. I know this is an area that could create a retradeable bounce. This is an area that could even reverse the market. So Pete lets everything get below that trouble spot, and he's like, I'm just going to jump in again. It cleared the fib, and I'll ride it down until that momentum goes away. And Pete, awesome. And the whole point that I want to make with this one is when you know where decisions are made, you can trade to them and you could trade from them. And the easiest trades are from here to here. Take a deep breath and look for it again. Awesome work. Because you know where the problems are. You know where the bouncy things are. You don't have to trade into them. We saw that one. That was a double post. And that was a double post. Pete, you posted the same trades twice. I don't know if that was intentional. They're still beautiful, though. Sometimes they get stuck on the clipboard. All right, Wayne. Wayne says, check it out, Mark. Good profit targets on gold. Just making money on the way down. Everything says down. And just keep getting paid. Nicely done. And then Pete. Oh, that was our news talk. The Guatemala news. 2, 3. All right, Miss Jen. All right, so we're going to go through Jen's chart read. So Jen is looking at her large chart, and she says, okay, I've got a strong bottom. I have a termination condition. It's reversed the market. Life is good. This gives me an indication that decisions were made right at a key area, and this is a pretty good spot for that market to begin to head back up. So Jen lets her large triggers roll, her small triggers get up, and when it pulls back to support in that trigger range, she says, I'm going to take a shot. And her shot comes right here at Fibonacci support with odds favorable momentum and a pullback to support inside of the triggers. This is like a very beginning of the day trend trade. And Jen, you did it beautifully. Now, one of the things that Jen did, and we had this conversation in the room earlier, is Jen called this favorable large triggers, FLT. And I want to talk about that concept. Favorable large triggers is a look that I used to teach in the very beginning when we talked about the best of the best entries. But what it did is it kept you guys from taking trades. It kept you guys from getting into the market because you were afraid of the risk. So I omitted it. What favorable large triggers means is your large and your synthetic are overlapping, one on top of each other. Your large and your synthetic on your small chart are like two snakes riding piggyback, because what this does for you is it gives you the smallest retracement zone, and it gives you the least amount of space for areas to be inside of those trigger lines, which results in the smallest risk possible and the highest accuracy possible. So favorable large triggers is a very specific look. Guys, this is the best of the best, highest accuracy, lowest risk way to take a trade. What Jen had was what we call split triggers. And I want to show you what it means. She still had momentum. She still had a clear path. But when she's doing her reversal bar math, and she says, okay, there's my reversal bar, the market may retrace somewhere between these trigger lines. So that elevated space creates a little more risk. She knew where her stop goes. And it also means, whoops, that your window of opportunity, because there is larger areas, it goes from the mid-band all the way to Fibonacci support. So there's more room for retracement, more room for bounce, and it just means a little elevated risk. Jen gets in towards the bottom. Her risk isn't too terribly bad, and the market does everything the indicator suggested that it would. But there's a difference between split triggers, which increases risk a little bit, and favorable large triggers, which will decrease that risk just a little bit. Odds favorable, still odds favorable. I love it. There's her first exit to critique myself. You're welcome. And it's just a risk thing, Jen. It's still a beautiful trade. And guys, just because I turned your charts into a lesson, it doesn't mean that I'm crucifying you for what you did. It means that there's an opportunity to be just a little bit smarter based on the information you gave me. And I'm going to try and give you everything I can to do that. So Jen says, to critique myself, I entered here on this one, not sure why, when the previous entry was here, which was a better entry. Can't remember my thought process. And Jen, there's a good chance that you were just afraid it was going to go without you. Did not get stopped out, but held through a lot of BS. BS means big stops, guys. BS is big stop. And it was a big stop. But it still did everything it said it was going to do, right? So Jen, when you can define that big range, sometimes you can insist. One of the things that we had a long time ago, and let me see if I can find the picture for you guys. We did a great lesson on what we called split triggers. And let me see if I have a picture. And the idea of split triggers, Jen, is kind of what you have going here. So there was a gentleman in the room that was struggling with these split triggers. When they were favorable large triggers, trades became easy. And when they were split, he was getting stopped out in that range because the risk was so big. And one of the things that he came up with, and I'm not saying this is a plan, I'm saying this is what this gentleman did. And guys, I see somebody is blowing up my my Discord, and it's okay, but I'm probably not going to reply. I do, Jen. I take a million pictures because there's lessons in everything. One of the things you can do, okay, cool, is I can say, and this is my thought process, I like to share it, my large chart is perfect. And that's exactly what Jen said, is her large chart was perfect. You should probably spell it right in case the grammar Nazis show up. My small chart has a lot of risk because the large and synthetic are so far apart. Doesn't mean that it's a bad trade, the wrong trade. It just means that you're going to have some extra risk on there, right? One of the things, Jen, that this gentleman did, and I don't even know if he's in the room, is he said, with split triggers, I'm comfortable waiting for a reversal bar off the area. This will define my stop and typically reduce risk. So when we talk about those confirmation bars, this is one of those great times, Jen, where you say to yourself, that's too much risk. That's more than I'm willing to give up. Now that confirmation bar makes sense, right? Now it makes sense because what does it do? Is it guarantees you the lowest risk at this point because you're getting in lower when this happens. I love confirmation bars when confirmation bars are necessary. Now, Jen, if you had a large chart that was absolutely perfect, where is my, there we go. If you had a large chart that was absolutely perfect, did I miss that? And You had the perfect, easy to define entry. No reason to worry about confirmation, right? It's perfect. But when it's not perfect, you can demand it. That's what we forget sometimes is you guys can demand that the market do what you want it to do to take your entry rather than just accept some high risk scenario that you're not comfortable with. So it's a beautiful hold, but you took the golden goose and you turned it into fried chicken by jumping in up here. And this is where I noticed that you didn't have your synthetics on there, and it created a nice bounce. Great trading, though. Great understanding. Let's celebrate a little more because I'm in a celebratory kind of mood today. Understanding where the market should not go. The lessons that Jen took through rule number 3 kept her in the trade and allowed her to get paid. Nicely done, Miss Jen. Still odds favorable in clear path. I love it. Pullback. Didn't get your entry. Missed you. And you said, wait, this is perfect. And you get in on the way up. Nothing wrong with that, right? You knew where your entry was. It didn't get you. That's okay. It happens. But you said, that doesn't change the fact that I have the perfect momentum. Everything is great. I'm going to ride it up. And you did. And then the ATM was wrong. And nothing worse than having to make $150 on a trade when you should have made $300, right? Bah, $150. Throw it out the window. Burn it. Great job. Great trading. Great trading. I hope it does. I've had some less than favorable feedback on my feedback lately, so I'm trying to be as warm and fuzzy as I know how, ladies and gentlemen. All right, Wayne, made my daily goal last night, did 3 trades this morning, went 7 for 7. All right, so every now and then you will have 100% winners. High probability trend trade for the win. Odds favorable momentum on 3 charts, clear path, and this is the same thing. Pulled back to the mid band, didn't quite get him, and Wayne says, dude, we're riding this down. That's the perfect look. Awesome. 16 seconds, $360. Great job, Wayne. Momentum and path. Momentum and path, momentum and path, momentum and path. All right. Paul, let's see what you're doing. Paul says, everything is going up in a strong trending market. And you went short. And you got stopped out. HVA short, what's it called? 23 still long. So on these 2 charts, Paul, this is where multiple charts create a fight, if you will. And I'm going to use just these 2. Not that you're only using 2. So the HVA rules, Paul, the first one is a termination. Large chart. And this was true. The rule was there. The second one is clear path large chart. And this was not true. Do you see, and this is the one that got you. Do you see that trade or how price reached Fibonacci support and all the triggers are above? So rule number 2 wasn't met. Well, you had a great look here. You had an awesome look with the rolling, but you didn't have any room to targets. And I can't see your entry here, but it's directly in. And then what happens sometimes, Paul, and this is, I guess we could call it the Mark Novak syndrome, is when this one doesn't work, you believe that this one has to, even though nothing's gotten better. And you take that second trade right at the fib. And I'm telling you guys, my ego is big. And Paul, I did this a lot. Well, since this short didn't work, those assholes owe me one. And I take this short. And what I don't look at is that termination. I look at the red and I think, man, it's got to go down. And the reality is rule number 2 saves the bacon 2 times on this one. If you just go through that process, path, 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 it helps a lot. Good stuff, though. And I love seeing these trades. I really do. Not because I enjoy seeing you guys lose, but because I think that there are amazing lessons in the losers. And while it pains me to say, wow, you just got run over, I can also say, here's why, right? Here's why you got run over. Because Fibonacci support held. Because you had the beginning of odds favorable momentum on a small chart. Your range chart was screaming north. Nothing said down except that little nagging voice in the back of your brain that says, I'll show them. I love the reasoning on the large chart. It was one darn blue line that messed up the party, Paul. Great stuff, man. Thank you for posting that. Thank you for posting that. You guys will realize through a few posts that you're human and that you do make mistakes and that everybody in this room is human. And we all make mistakes. Oh, Jen, that was your, do I have my synthetics? Let's do that. Let's take a break from chart reads real quick. And I want to talk about why I pointed out to Jen that her synthetics were missing. Because this is a good one. This is a great lesson, guys. And it's just a little bit about how the software creates advantages. And when you look at a large chart, I love this. There's actually 3 different time frames of Fibonacci levels on a large chart. And guys, these 3 levels are there because when John Novak created the software and he created this plan, what he realized is that he can increase the accuracy for you guys. He can increase the likelihood of success. So every time you look at a large chart, you're going to see skinny fibs that don't print all the way to the right. These are from your 5-1. These are from your entry chart. You're going to see a 21-3, and this is a higher time frame, giving you something to look at from one of those synthetic time frames, even higher, a bigger, broader scope. And then you're going to see the ones that go all the way to the end, and these are native to the 13-2. And when I started, I like to say, well, this is only a 5-1, I'll trade into it. Or this is a 21-3, even though it's 50-50, I don't want to take the trade. And I would start creating these rules and try to rank these things in levels of importance. Well, that's only a divergence high. That can't be as strong as a 1-to-1. And since a 1-to-1 isn't made from thousands of calculations, this doesn't carry the same weight as a fib. On your large chart, every one of these areas are equally as important. Every one of these areas can stop the market. And you'll see that even on this picture, the 21 fib stopped it, the 5-1 fib stopped it, the 13-2 fib stopped it, right? You even have divergence lows that stopped it. So when Jen presented a chart in this room this morning that didn't have those synthetic time frames on it, I recognized it and I said, hey, Jen, guess what? There's a little more accuracy to be had with those synthetics, and she fixed it. And just a little bit on the whys, why I think it's important to have all the information, because all the information is going to increase the likelihood of success. All right, where was I? Sorry, that was a little digression, wasn't it? I believe we have Cav next. So Cav, large chart, has a clear path. Large chart has the beginning of momentum. Large chart has an area right in the retracement zone. Nicely done. Great trade, Cav. You have the beginning of momentum. The path is absolutely clear. You're coming from Fibonacci resistance, and you define your entry right at the area inside of triggers. Nothing to say about this one other than high five. Great job. And I just got lost. And now I'm found. All right, the king of chili dogs, Ron C, says, there's something I want to share with you guys. And guys, he shared this with everybody in this room. And there's a lot of you guys making a lot of money with this look. When your large chart has odds favorable momentum, when your large chart has absolutely nothing in the way, and everything is screaming down, Ron says, I've realized that I can take $110, $112.50 out of the market pretty consistently. And it wins more than it loses. And price clears trouble. In a little late because it was moving fast. Price outside of the smalls, large both stacked, in after trouble and out before trouble. Base hits pay bills. Amen. So the idea is that when everything is screaming and there's nothing to stop it, there's an opportunity, momentum, and path. And guys, he shared this classroom, and I see a lot of people taking it. And there's a lot of people that make mistakes with it. I did in the beginning, because people would take this trade without letting price get away from the decision-making zone. And they kept wondering why retracements were pulling them out of the market, why they were getting stopped out when Ron keeps winning. Because Ron lets the back of the bar, he lets 100% of price action get away from the decision-making zone, guys. That is the keys to the kingdom on that one. Paul, let myself get involved in this consolidation, the fight for direction on trades 2 and 3. From fib to fib to fib to fib to fib. Yeah, they're spiking and dancing and bouncing, and man, they're just not given a clear path. It happens sometimes. Consolidation, getting caught in it, is easy to see after the fact. In the moment, I think this is one of the reasons clear path is proven to be so effective. You'll begin to recognize when areas won't break, and it'll help you to find the range that the market needs to break out of before you start looking for trades again. I love rule number 2. It helps in that regards a lot. And crude oil does tend to do that before inventory. That's why I was saying this morning, Ron, they jockey for position before inventory. The buyers and sellers fight to put themselves in the best position. Clear path. John was in the room Friday, I think, Paul, and he was talking about trading in determination conditions seems to result in about 80% losses on those trades. But it's still the most broken rule, because that's the rule that forces us to be patient, to wait for the best of the best. And that's what we're overcoming. We're overcoming the desire to predict and just going with, hey, here's my pattern, here's my advantage. And if you don't think that it'll be a little bit of a fight for you, it probably will be. But repetition and annotation and feedback, guys, that's what helps you overcome it. So Jen, pivot, stop out. Price reaches a divergence high. Triggers can't break it. Market reverses. That's a strong top. Smalls are still above, but from this termination, you sell the pullback to the large triggers right at resistance. You get in on the way, well, you actually got in on the way up. After the confirmation, it came up to scare you, but you had the advantages and you pulled it off. And Jen, this is the trade from 2004. Termination, let it roll, sell the pullback to the small triggers. It looks just like the pullback to the large triggers. And that lower divergence creates warm fuzzies. Taking advantage of the pivot stop out. And I want you guys to see something. You are in a little late, I agree. So this says 2025 on it. And most of you know what I'm doing. If you're new to the room, to the software, if you are learning to believe that patterns repeat themselves, and I think that you have to learn and believe that patterns repeat themselves to be confident, I want to show you this. And this happened in crude oil in 2021. And I'm going to set this picture from 2021 next to Jen's picture from today, where price reached Fibonacci resistance, had a little bit of strength in the move, pulled all the way back to support close to that mid band, retraced all the way back up to the divergence high, creates a pivot stop out, and that's where Jen finds her opportunity to go short. And everything that happened here in 2021 was mimicked right here in 2025. And this is an amazing testament to how often the market repeats itself, and how once you begin to learn these patterns, you can create an edge. Nicely done, Miss Jen. Great patience waiting for that to be perfect so that you could capitalize on that termination condition. Patience is hard. Cav, did we look at this one? Nope, not yet. Let's see what we have. If it doesn't repeat, it's not a pattern, just an occurrence. I like that. I'm going to use that. Cav, your first trade got in on the way down, so waited for a little bit of confirmation. 943, 943. So Cav says, okay, termination, trouble, pull back, breaking, pulling back, and it's not perfect, and he's on the wrong side of everything. Yeah, I'm going to run out of nickels, Ron. He says I'm on the wrong side of trouble. Good morning, 10K. No worries. So he says, I'll force it to go down. My large chart says down. My small chart doesn't agree. I'll force confirmation. And he makes money. And then everything rolls and gets pretty. He lets the shenanigans work through. And then he catches it on the way down again. Nicely done, Cav. Great patience once again. Guys, if it's not perfect, you can force it to do what you want it to do instead of just jumping in. That's what experience teaches you, I think. Pete, there's that pattern. It rolls, and you catch it on the way down to the fib. There's your jump in, turns into a trend trade, take it off at trouble. And it all starts with that pivot stop out. It all starts with that termination that rolls, that creates momentum, room to the target, understanding expectations. Beautiful job, Pete. Odds favorable from a strong bottom. One more term to get through. And Pete says, you know what? I'm going to see if I can make a little money with momentum on the way up to trouble. And you did it great. You get in above the fib. You've got momentum. You get out at trouble. Great recognition. Nicely done. And then Cav says he met his goal for the day. And he did it with momentum and the potential to break. Takes the first 50-50 trade directly into a termination condition. Gets paid. Takes the second 50-50 trade. Gets paid. So the first trade, watch this. Cav's feeling like Johnny on the spot right now. Heck yeah, check it out. Here comes jerk face Mark. Cav traded into a termination condition. Can we agree on that one, Cav? But I want you to see why Cav did it. And Cav, if I put words in your mouth that don't belong there, please correct me. Guys, I don't get mad when you trade into termination conditions. It doesn't affect my day. But I'm going to show you through Cav's chart what happens. It's not even a correction. It is an acknowledgement of greatness. This is the recipe for the perfect trade. A perfect trade is momentum, it's a clear path, and it's an entry area. And this is why I stress advantages in the beginning. So Cav has momentum for days. Cav has the perfect entry area. The one thing Cav doesn't have is a clear path here. Price reach resistance, the triggers are below. He's got 2 out of 3. And then just for bonus, Cav is coming from a strong bottom, which adds warm fuzzies to the mix. So Cav, what I believe you probably did, because you're an amazing chart reader, is you said, I have 66% of the good stuff. I know where the trouble is. And if something changes, I'll manage assertively. You'll notice that Cav's exit is right at the trouble spot. He says, I'm not going to hope it breaks. I'm going to hope they retest with all this momentum from a strong bottom. And this is where exceptions to your plan begin to come in. This is where the growth of your plan really happens. When you start talking about these 3 advantages, you can say to yourself, I am 66% of the way there. I can define my entry. I can manage my risk, and I know where trouble is. I'm willing to take this trade. Does it guarantee a winner? Of course not, because that's the same darn look right there, and you get run over. It's what you say, it's what you call a calculated risk. And strong bottom, momentum, perfect entry, trading with the trend, termination. If this were a bar fight, I want to be with these guys because they have a better chance of beating up this guy. A little crass, I know. So, Cav, is that about right? You gauged it and you made a choice and it worked out. And then the other side of that question is, Cav, would you have been surprised if this trade was stopped out because you traded into a termination condition? Probably not. And I imagine that your risk was pretty tight on a trade like this because you know what you're up against. And this is my hope for everyone in the room. My hope is that you look at your chart, you gauge advantages, and you make a decision based on what you see. And I think this is one of those shining examples of how that can be done with a little bit of really just focus. This is my advantage, this is not. Miss Jen, I think you double posted. I think that showing me your synthetics was still pasted. At 10:29 was the link, but I believe that is the same picture. And then Pete, these are the two. Warm-up trade and sim. I like that you do that. Pete says, you know what? I'm going to have to warm up a little bit. Let me make sure I'm making good decisions today. And Pete, with all the momentum and everything going up, you take the momentum style trade. And now, guys, we're going to discuss a phenomenon that I like to call testicular fortitude. For you ladies, it's probably ovarian fortitude. When you take a momentum trade that loses momentum, that gets divergence from right by the fib, and you hold it through all the nonsense below the triggers, and then you hold it even longer to the fib that could stop the market through 3 divergences in the same price range, and then finally exit. This is for the brand new user learning how to be successful. This is practicing the wrong trades. This is keeping a ridiculous amount of risk on a trade. This is ignoring all the termination conditions and when the disadvantages outweigh the advantages. Pete will do this on sim, and Pete knows the difference between a risky, high risk, everything's gone wrong trade that he's willing to hold just to see, and the trades that Pete takes in his plan. I encourage new users to avoid this behavior, to avoid trying to get lucky and breaking rules intentionally, because what you're doing is your body doesn't know the difference. Your brain doesn't know the difference. And these little short-term victories, when you try to pull it off in a live market, they tend to stomp you pretty hard. Strong trending markets, and I love this. Pete trades to trouble, gets out at trouble. Trades to trouble from 61 below the trouble, takes half of them off right at trouble, nothing slows down, takes it up to the fib. Beautiful. And Pete, that was your real account. Because this one fits his plan. This one was a sim account because this one doesn't fit his plan. And maybe Pete's working on a new method. Maybe he's working on a new pattern. Maybe he's working on a new hold. Maybe he's working on a low probability trade that tends to repeat itself. And Pete is at the point in his career where he's doing that. And I love that. 3 divergences in the same price range. 3 divergences on the way down. That market is likely to go down. And Pete says, man, I'm going down with it. Usually do 3 warm-ups before going live. So Pete doesn't have a clear path, right? But Pete says, I have every indication on both charts that this market is more likely to go down than up. So he waits for the small chart to agree. This is what I love. He waits for the smalls to be below the large, for the large to be angled down, starting to weaken those synthetic triggers. And this is beautiful, beautiful. And he takes it all the way down to trouble, right at 24. Really nice, Pete. Great chart read, leading to the ability to make money. All right, 10K. Like yesterday, waited for all triggers to pass the fib. Strong triggers made go at the fib. Small chart was not in line, but small triggers was outside on the large chart. Should have waited for the reversal bar or close on the right side of the small triggers. I think the better way if small is not in line. Double divergence on small made me second guess, but I think this was the best place to get in. I like it. So 10K, let's do a little pattern thing. You're going to like this because I think, and this is the RTY, is that right? Every market has a personality. And one of the things that I'm noticing about this market, 10K, is that you seem to get overrun below these triggers a lot. Is that fair? Are you finding that it does push below those triggers, maybe a little more than it does in crude oil or the S&P? It's usually a market personality thing, quite a bit. So check this out. We're going to go off the exact same concept that we talked about with Jen's chart earlier. I don't know if you were here for it. If the large chart is perfect, but my areas on the small are below the triggers, below the large synthetic triggers, and 10K, do you recognize this as where the market should not go? And this is just what you're looking at, and you read it perfectly, right? This is one of those instances, just like you said. Because my entry isn't perfect, and you know it's going to be not a lot because RTY seems to overrun, it's okay to demand a reversal bar in the direction of my trade. Because that gives confirmation, and it also gives you something to put your stop 2 ticks behind. Your entry is great. Your entry is right there, right at the mid band, right inside of those triggers. Your stop is rock solid, and your profits make perfect sense. I love this trade. But because I'm noticing that you do tend to get a little bit of that overrun, maybe that confirmation bar will pay dividends. You'd have to do a little study on it. I'm not telling you how to take your entries, but I'm saying that that's a very common trick when the entry isn't perfect, but the large chart is. Really nicely done on this one. I like it. And I'm going to talk about one more pattern that you'll see a lot. And guys, this is one of those times where I take a lesson from your chart that maybe you don't need or want. When I have two divergences here, so when I have a pivot stop out above me and I'm looking for a long trade, very often it creates a pivot stop out below. Oh, thanks, Cav. Have a great one. So check this out. I think you'll dig this. And because it didn't actually have a divergence here, do you see how when you get the pivot stop out up here, 10K, it creates the pivot stop out down here, and then it goes? This is creating an expectation based on a pattern. Because of this, I know that it's probably going to take out that previous pivot. And guys, this is pretty cool because this is something that happens a lot. And let me see if we can find an example. Just for grins, I'm going to circle a tail at 1108. Well, that's just perfect. I mean, I hope you guys caught that. And that's odds favorable in a clear path, only one divergence. Rules say go short at an area inside of favorable large triggers. But what happens, and I want to see if I can find this, on their small chart, if you get a pivot stop out prior to an entry, here's a good example. Maybe you were looking for the long, two divergences. It takes out the previous pivot, and it's on the wrong side of everything, so you don't get it. Here it is again. Pivot stop out. Do you guys see it? There's my pivot. This is where it gets stopped out, and the market doesn't go back up until it creates the pivot stop out below. This creates some expectations, keeps your guard up, maybe has you waiting for a confirmation bar. Pivot stop out, looking for the short trade, it comes from the pivot stop out above. Does that make sense, 10K? That has nothing to do with your trade. Your trade was amazing. Your trade was an awesome high probability trend trade with a great entry and awesome stop placement. But I think that there is a pattern that can be recognized in that pivot stop out. Odds favorable, clear path, beautiful entry, easy money, textbook trend trade. Strong bottom, no divergence, back to crosshairs. I like that you call it the crosshairs. Someone used to call these entries the sniper entries. You got in almost low tick at an area inside of favorable large triggers, 10K. This is about the least amount of stress you could ever have on a trade. I mean, just awesome trading. So far, so good. Great day this morning. Thanks for posting those. All right, Miss Jim. Weak bottom, odds favorable, potential to break. There's the first entry. You get in with confirmation and you get paid. And then Jen, you held through 1, 2, 3, 4 divergences, a trend change, odds favorable momentum, and you get paid up at the fib. Now let's talk about no mark. I won't be doing this again. I've got to read all of these. Let's talk about large chart advantages for a second. If all I showed you was this right here, is there any indication that that market wants to go down? What do you guys think? If that is all you were looking at, you would say, Upsville, population me. I can't wait to be a part of this trade. I can't wait to see all this up, to see all this greatness. I'm going to find a way to capitalize. And guys, Jen does. She finds a way to capitalize. And this is some nonsense, and I love it. She's like held through all the dance, large, still, odds, favorable momentum. Remember when I said that your second contract will begin to develop trust? Your second contract is going to make you believe that you're more likely to go up than down when everything says up. So Jen takes this, and Jen makes quick money. So she's got $100 in the bank, which means that her risk to be break even on this trade is somewhere down here at support inside of triggers. And Jen says, you know what? It's worth it. With that large chart, look, I will keep my stop where the market shouldn't go and see if the large chart wins. And it did. And it did. Nicely done, Jen. That's some trust. Did you give up some advantages? Yeah, that's okay. But here's the deal, Jen. You're not in your first week, right? You're not learning to read your indicators right now. You're learning to react to your indicators. You're learning to take trades that make sense at entry, and you're learning to create a management plan that makes sense. And sometimes you've got to do this, right? I almost like get in here at the perfect entry, get paid, take it with one divergence again, maybe make a little more money, and then just sit tight. And then when everything rolls, Jen, and you get that snap back to the one-to-ones right inside of those small triggers, make it again. You don't have to sit through the nonsense to make money. You did, not knocking you for it. But I think there was a great opportunity to take the correct entry, not the reversal bar, because you had odds favorable, clear path, no divergence, well-defined low risk. And then you get paid, and then you sit, and then you get back in and get paid again. Nicely done. Thank you for sharing that. Sometimes people are hesitant if they're like, oh, you know what? I know this isn't perfect. I don't want them to think I ever make mistakes. And all of you are perfect in my eyes. But perfect people make mistakes. All right, weak top, huge big momentum, wide separation, odds favorable momentum. You get in again. when the large sugars roll and give you momentum, you hop in, you ride the momentum down, and then when it turns into the trend trade, you do it all over again and make it again. Great job, Pete. The jump in trade, and as long as the momentum is strong, he'll stay in it. And then when that one fails, turns into a trend trade. And you say with divergence until reversal and confirmation bar because you're at the mid band. And Pete says because it's a weak top, I'm at the mid band. But what you missed here, Pete, and I like that you missed this because a lesson, 1, 2, 3 divergences in the same price range. It reversed the market. You actually had a strong top. And because those large sugars weren't a full bar away, the mid band is no longer in play. Does that make sense, Pete? It's still amazing trading, but it might have gotten you in at the mid band. It took me a second to recognize that as well, and the market's not even moving. That's another one of the reasons, guys. I think that the feedback is so important, is you got to remember that I'm looking at a market that I have no fear of losing. I don't have to read it in the moment. I'm looking at it after the fact, and all I'm doing is going through my Rolodex in my head. Have I seen this? What does it mean? What am I looking at? Did I miss anything? Did he miss anything? And we get to go after it together and see if there were any things that maybe we didn't see. I love it. Boaz. Odds favorable momentum, clear path, perfect entry. And if you didn't catch the first entry, they came back for you. And then you get in and off it goes. So Boaz, I'm going to assume that you were out getting coffee or toasting a waffle because I know that's your entry. And I know that's your entry. And even though you didn't get the two best, you still managed to find a way to ride momentum and path all the way up to the fib. Really nicely done. Odds favorable, potential to break. There's the entry. Perfect stop placement. Why the 2 ticks? I would be curious. I don't know for sure, but I don't believe that your ATM strategy says enter a beautiful trade and make sure you exit with 2 ticks. And then the real hold. Nicely done. Just curious. You might want to write why. Why did you take that exit? You got suckered by what? Oh, you got scared. Okay. Take one off. Feel like you have something to bank. Makes it easier to hold, right? Nothing wrong with that. I've seen that a lot, Boaz. So let's talk about it real quick. I had a lot of fear in trading. And let's go through all of it. Odds favorable momentum says, and I'm going to use the language. This is a market where the odds are favorable for it to continue down. This is a market with that level of momentum. It has the potential to break these areas. These triggers are as strong as they can ever be, supporting the idea that there is momentum to break the areas. Your entry is rock star perfect. Your stop is phenomenal. And you've got these green triggers up against you. And just for grins, everything here is south, screaming like a banshee. So one of the things you can do, Boaz, and this is where repetition comes in, is you can go back and start clicking on these pictures. This is the same look as yours. All the momentum, potential to break, strong triggers, perfect entry. And those small triggers turned against it. And I think this is what scares people, is the small triggers turning against their trade makes them think that change is coming, that things may go wrong. And I don't know if that's the case with you. So now we go in Odds favorable, potential to break, perfect entry, small triggers rolled again. Okay, so now we're 2 for 2. Those small triggers seem to roll when it's the perfect trade. Let's look at it again. Odds favorable, potential to break, perfect entry, and the smalls rolled again. And Boaz, I don't know if that's your trigger in the fear, but sometimes if you just take a deep breath and go back and look at what's happened historically, this was one of the biggest reasons I would stay out of a trade as a brand new user, because I would say, oh no, the market is turning against me. Oh no, the momentum isn't in my favor anymore. And I had to go through it. Maybe chart 3 showed you support in green too. Chart 3 showed you odds favorable momentum to the downside, 100%. Chart 3 had an area that could have potentially been trouble, but that wasn't until 30. That wasn't until all the way down here. This green spot, that's a great spot to take your first profits. That green HVA, absolutely. Get your guard up. But look what your chart looked like. And I'm just going to look at the small chart for you. And this is what I love. When you got to that area at 2030, right here, your small triggers had rolled, all your prices left of them. There is zero indication that this market wants to do anything but go down. So I love the awareness of the HVA. That's a great spot to take that first profit off, because with all this momentum, it's likely to hit it. And then if you want, go break even, get stopped out. That's cool. Or keep your stop in place. And if you get a reversal bar or something off of that area, divergence prints, then you manage a little more assertively. I love this because it's a beautiful trade and it's a great result, and there's an opportunity to maybe get one click better at advantage by remembering that momentum on 3 charts is hard to stop. Great trade, Boaz. I hope that all made sense. Odds favorable momentum. Awesome. Potential to break. There's the entry. It's a late entry. That's okay. It happens sometimes. Out at potential trouble. And then when it comes down to here, it turns into the perfect trend trade again. That was the first entry. And then the second higher divergence creates the challenges. So with momentum and path, it still didn't work out. Should have exited as soon as that third divergence printed. It's only 2 divergences here. When small and large triggers get below the fib is broken. So Pete, the same is true here. When the large and small get below that first divergence, it's out of the equation. So we actually go back to this being divergence number 1. Does that make sense, everybody? So when you're doing a divergence count, you actually had 2 divergences. Everything was perfect. You had 2. I love it. It just didn't work because 3 divergences takes you out for the brand new user. Pete, there is a little truth to the pattern. A second higher divergence very often pushes it a little higher. You're welcome, Paul. Nicely done, man. Joel, let's see what you're doing, my friend. Odds favorable, clear path, perfect entry, quick profits, out break even. Rock star. And guys, the first entry is pretty much always the best entry, and it's the one that creates the highest opportunity. And Joel, you were able to take a high probability trend trade that ultimately failed and still make $100 on it. Really nicely done. All right, Miss Claire, Chris got you set up on TV. You did market replay, but now your charts are wonky. Can I take a look? You know that I'd love to. No divergence lines. Request historical offset. I don't know what this means on the historical. So you have your zones, you have your triggers, you have your divergence, but there's an exclamation point, runtime error. So S&P 500, Claire, let's try this. Let's try this, if you want, if you will. Click your little plus tab over here. And this is new for me. I've never seen it. And create a new layout. And it's going to bring up one chart. Brought up gold for me. Come over here to your layouts. And let's find an S&P layout. It's going to be saved in there. And click on it and let it kind of recalculate. And see if that gets rid of the runtime error and puts those divergences back in. That would be the first thing that I would do, is just try to get it fresh, because there may be something corrupted. I've never seen it before like that. So to go through it one more time. Are you listening? I want to make sure you're in here. There's nothing worse than missing out the information. Give me a Y if you're in here, Miss Claire. I want to get you taken care of. How are we feeling, ladies and gentlemen? It's been a pretty awesome class. Lot of good stuff going on. So let's go through it one more time. So click the plus, and let's create a new layout. And then from here, we're going to go to the drop down. I like that. Always good. How's it going, Tim? And let's find that S&P. Open the layout. ES. There it is. ES futures copy. And that should bring everything up good for you, Claire. If it doesn't, for some reason, and let me know if it does. When you do that, let me know if it does. But if it does not, we'll go to Plan B. Plan C will be Jason. But we're going to see if Plan B works. Wow, that was a good one, wasn't it? Is anyone going to show me this picture? That's a good look. So Claire, let me know if that works for you. If it doesn't, we'll see if we can find another solution. A big fan of finding solutions. My life revolves around finding solutions. There's a guy that I watch that's a golfer, YouTube golfer, and he says that golf is such an amazing sport because you get to solve one problem after another. And I think that's kind of fun, the way that works. So Miss Claire, I'm just waiting for the thumbs up from you, or the thumbs down as you go through that. What do you guys want to talk about? We've got time. We've got time. Time is on our side. Ron C, you gonna scoot? It's 80 out there. Nice. Man, we've been in the 90s here. And one of the things about the Pacific Northwest, I don't know if you guys know this, but most of the houses don't have air conditioning.